stabilization staff and other staff. It's great to have you here as well. All right. I'm going to go ahead and introduce Grace Reef, who's here with us tonight. We are so grateful and honored to have you here with us tonight to present this training for our child care providers. She's the founder of the Early Learning Policy Group, LLC, a Northern Virginia-based early childhood consultant firm. A veteran political and policy strategist, Grace worked for 17 years in the U.S. Senate as a senior policy advisor on issues related to families with children. What she likes to call when she's off Capitol Hill, Grace was the chief of policy and evaluation for 7 years at the National Association of Child Care Resource and Referral Agencies, currently doing business as Child Care Aware of America. Grace's experience ranges from child care, Head Start, and pre-K policy to welfare reform and family economic stability. Grace has worked with a number of state coalitions in partnership with the Alliance for Early Success, seeking to strengthen access to quality childcare, engaging business leaders in partnership with the Committee for Economic Development, as well as supporting early childhood shared services strategies and childcare provider networks. The Early Learning Policy Group focuses on strengthening the quality of childcare and early learning at the federal, state, and local levels through policy analysis, strategic thinking, and partnership building, effective communication and advocacy approaches, and pursuing alternative financing strategies and best business practices to support early childhood initiatives. So without further ado, Grace Reef, thank you so much for joining us tonight.
Hi, thank you everyone for coming tonight. I'm really glad you took the time, particularly at the end of a workday, to listen in and learn more and, ask questions. I'm hoping everybody understood when they got on. You can choose between the English or the Spanish channel. So hopefully if you would prefer to hear this presentation in Spanish, you select the Spanish channel, and in real time, it will be translated. And if you have questions, just pop them in Spanish in the chat. That's fine. They will get interpreted to me. I will answer them. And of course, if you have a question in English, be sure to type that in. I want to say my whole goal is basically not to bore you today and to enable you to understand there are no dumb questions. If you have a question, ask it. Don't feel that anything is something you shouldn't ask. If you got a question and it's related to the webinar, don't ask me what the weather's going to be tomorrow. I have no idea. It's 30 one day and 60 the next. So don't ask me about the weather. But if it's something related to this topic and you have a question, please feel free to use the chat, and I'll do my best to monitor it. And the staff from the Early Care and Learning Council will as well. And Claudia will watch it for Spanish questions. So hopefully we're good. And with that, I will begin some slides. Okay, hopefully you are now seeing my screen. Can you give a thumbs up if you do? Excellent. Always good to know we're on the same wavelength. So I want to tell you, this has been kind of, this past 2 years in COVID. I have 3 kids, and I probably have more than 2 Scrabble sets in my basement, but I went through my Scrabble sets to try and put together all of the possible grants that have come down the pike from the federal government. And so, whether it was the SBA or whether it was, the CARES Act, I tried to put them all in there. And in some way, I will probably touch on all of these things at some point during this webinar. There's a lot that's going on. It can be confusing, but here's my goal. My whole goal is it's tax season. Don't let it get you down. I want to talk to you about some of the concepts so that you can feel confident in knowing the basics and I can help respond to some questions. So I use these emojis at the bottom just because otherwise this could be kind of boring. Oh my gosh, she's going to talk about taxes. Yikes. But this is generally when I tell people I'm going to talk to them about taxes, how they respond, like all of these emojis. So what I want to do, hopefully, is to walk you through some of the concepts, make you feel comfortable. So you don't respond with like any of these below emojis. You are like, I'm ready. I've got a lot better handle on it now. That's my goal. So 2021, what a year, right? Like, I think many of us thought COVID would be over in a few weeks. And then we thought in a few months. And then we thought, well, maybe next year. And now here we are going into what? Year 3, things are better. That's a good thing. But if you're running a business, you know, there's still up and down with it. I know that many centers and homes have struggled with enrollment. It's been up and down. And I know that many have opened and closed, you know, based on, you know, positive COVID tests. So it's been tough. And obviously opening and closing and low enrollment or fluctuating enrollment all affect your revenue. And that affects your income, your budget, your taxes. So I'm going to go through some of the things related to the stabilization grant and other grants that were that people may have gotten, just so that you understand the connection between the two, because there are ways to recognize those grants as income, which they are, but also use them for ordinary and necessary business expenses. And that's a tax deduction. So we're going to talk more about those concepts. Hopefully, like I said, handling grants, understanding how you spend the grants and how that might crosswalk over to a tax form. I'm going to actually show you the forms. So I'm not just going to bore you with it. I'm going to say, hey, look at this line or look at that line. Hopefully the takeaway for you will be, wow, one of the ways I can really maximize my income is by reducing my tax liability. And how I do that is by taking tax deductions that I'm allowed. So I'm hoping after this webinar, you're going to say, I'm a lot more confident about understanding what I can deduct. And that's going to mean I'm going to pay less taxes. And that's my goal. So we are going to talk about record keeping. I'm going to try not to bore you, but I'm going to connect the record keeping to taking those deductions that reduce your taxes. So hopefully we're going to get there. And I do want to flag for you, and I put this in red letters. I'm not here to do your taxes. I'm not rendering legal, tax, or professional advice, particularly unique to each individual. If you require this, you should really reach out to somebody. Actually, I have a slide on where you can get tax help for free. That's kind of toward the end. But I just want to be clear. I'm going to talk to you about policy. I'm going to talk to you about tax concepts. I'm going to go through some forms with you, but I don't want that to be misinterpreted that I'm giving you some kind of legal or tax advice specific to the operation of your business, because I'm not. Concepts, policy. Tax preparers are the people you should go to for that specific advice unique to you. So I want to start at the beginning. I noticed as people put in the chat, they mentioned if they were a center or a family childcare home. I want to, make sure I'm talking to family childcare homes and that a lot of the concepts are the same, but that I'm going to start with a common denominator of, hey, if you got a stabilization grant or CARES grant or any other kind of grant from the state, you probably got a 1099. And what is a 1099? It looks like this. This is a screenshot of a 1099. And I want to talk about it a little bit because by law, if you receive more than $600, you're supposed to get a 1099. It might be from the state. It might be from your local child care resource and referral agency, depending on where the money flowed through. Some entity might send you in the mail this 1099. And so this is the form. And if you look at the red line, I put in 15,000 just for illustrative purposes, but that's the income. So for example, that might represent I think the stabilization grants in New York are like 6 monthly payments. So maybe that represents one payment, but maybe you got another grant from the state. So that's lumped in on top of it. Maybe you got some subsidy money or extra subsidy money, or maybe there were grants for health and safety or some other purpose. So you could get a 1099 with one lump sum. And I've seen it done multiple ways in different states. Sometimes I just see these 1099s go out in an envelope, people open the envelope and they go, oh, wow, that's a lot, because it's combined all these different things. But it's not necessarily explained. It doesn't come with a letter saying, here's the 15,000 and here's how you got to this 15,000, all the different things that were combined. So I don't know if you got a 1099 or not. I don't know if you got it in one lump sum with a letter that also explained how they got to that big number or how you received it. But what I will tell you is, if you got some kind of grant for whether it's stabilization or some other purpose, and you did not receive a 1099, you still have to claim it as income. So if you did get a 1099, great. I would tell you what to do with it. If you did not, but you got some money and it's more than, $600, you can contact the organization who didn't send the 1099, say, hey, I don't have this yet. Are you sending it to me? Or you can just claim what you know that you got. And I'm going to show you where. So here's a Schedule C. This is what it looks like. If you look at the red line, the amount of money from the 1099 goes right to the line that says other income, which is line 6. So you can see the red line. This is like a lump sum that may represent multiple grants. That's okay. You may not have gotten something that explains that. That's also okay. But what's important to understand is there's no like invisible money. So if you get it and you didn't get a 1099, you still have to claim it, because chances are the state probably reported it, and you don't want to have a situation where the state reports something and you didn't claim it, because that is something that could trigger an audit. So whether or not you got a 1099, you need to add up the money you got from the state for the grants of whatever type they happen to be, and count them as income, put them on the Schedule C. I'm going to show you what it looks like in a bigger slide, because I always like to see it a little bit bigger so that you understand. Hey, side by side, here is the 1099, and you can see the red circle where the income is. And here is the line 6, other income, where it goes. So it's pretty easy, but sometimes it's good to see the forms side by side so that you see it. So most often what I'm asked is, okay, so, I got this money, and what's a deductible expense? I just want to make sure, I'm doing the right thing. So I thought I would just go through what is a deductible expense. If you're a center, it's pretty easy, because for a center, you're in a situation where probably everything you purchase is related to the ongoing business of providing care for kids. So that's easy. But if you're a home-based provider, sometimes you don't know, well, is this deductible or not? So what I wanted to go over with you is expenses are deductible if they are ordinary and necessary. And that's the IRS language for your business. So in general, that's pretty broad. It means, in undertaking your business, what expenses you make to operate that business. So for example, you may clean your home to get ready for the kids, or clean at night after they leave, or particularly during COVID, there might be a lot more sanitizing that you do to ensure the health and safety of the kids in your care, as well as, your own family. So cleaning costs, sanitizer, maybe you wear gloves, laundry that you do, laundry detergent. All of these things are a cost of your of operating your business, not just the materials you might purchase for kids, like Play-Doh or art supplies or books or maybe a sand table or toys. All of those things that the kids use, those are supporting the business of childcare. But these other things that you might not necessarily think of are also expenses for your business. And so I think you want to think very broadly about the expenses that help support your business, because chances are those are deductible expenses. So for family childcare homes, like centers, just about everything you purchase is, a cost of doing business. If you're in a home-based program, it's often a shared expense. For example, if you're doing laundry, you would, maybe do towels and maybe clothes for the childcare kids, but you might also do your own laundry. So, for example, a washer and dryer is an example of a shared expense because you're going to use it for the purposes of your childcare program, but you're also going to use it for your own family. So it's a shared expense. And there are other types of shared expenses, and I'm going to show you the form where to claim it, but you can deduct part of the cost of these items that are shared. And I will go through that form so that you see. For family childcare, literally, I want to say there are thousands of potential deductions for you. What you really have to think through is, do I use this in my business? Do the childcare kids use this while they're in your home? Do you use these items to support your business? Like, the TV, for example. Hopefully you don't have it all on all day, but maybe you play a segment from Sesame Street, so there are shared things in your home that your family may use, but also are used to support your business. And those can be partially deductible. And I'm going to show you how. So I've listed a bunch of the deductions. There are lots, as I said. If it is something you use exclusively for your business, like your family doesn't use it, then it's 100% deductible. If it's something that's shared, that's completely okay. There's something called the time-space percentage that is applied to it. And I'm going to go over that. I'm going to explain it to you. Well, what is that? And how does it work? And what's the concept behind it? And what form would I use for it? I'm going to show you those things so that, it's clear. So the time-space percentage, basically what it is the time you spend to support your business. Now, I've seen a mistake by family childcare providers, and it's not, obviously it's accidental. It's because people don't know. But I've seen people's on their tax forms when they're asked how many hours they use their home, for their business. Oh, well, I care for kids from 7 to 5. So, those are the hours I put in. And I'm like, no, you need to count all the hours it takes to support your business. So most people I know who are in the business of family childcare, for example, that is not just like 7 a.m. to 5 p.m. that they actually, make care for kids. That's also the time it takes to support your business. For example, if you are cleaning before the kids come, if you clean after the kids leave, if you are watching this webinar right now, that's a business use of your time, because that means you want to learn, how to think about grants you may have received, expenses that are deductible, the forms that you should use. This is time to support your business. So if we're on here for an hour and a half, you should write that down. That should be part of your time. The time you spend planning. You might spend time planning, what's the schedule going to be this week? You might spend time making a grocery list. If I offer food in my program, I'm going to go to the grocery store. I need to plan ahead and figure out what it is that, you're going to serve this week. the time you spend on planning is time to support your business. So all of the hours, maybe you go to a training of some type, that's time you spend to support your business. So I want to make sure that that's completely understandable, that this time space percentage, it's the amount of time you spend to support your program, and it's multiplied by the space in your home that's used to support your business. And so the space might be, for example, maybe you use your den, maybe the kids eat in your kitchen, maybe you have 2 or 3 bedrooms and the kids may take naps in different rooms. Think about where the kids spend time. Think about, maybe you have a refrigerator freezer in your garage, maybe it's in your basement. Maybe the kids don't go there, but the fact that you may use that refrigerator freezer for the operation of your childcare business means that you can count that space in, as far as, space that's used in your home for your business. So it's kind of important to think broadly, because the more time that you can put into this equation and the more space that you can put into the equation, because it's the space you use for your business divided by the overall square footage of your home, that's multiplied together. It's called the time space percentage. So for example, let's say you wind up with 60%, your time space, your time percentage times your space percentage, maybe it's 60%. Then that means you can take a 60% deduction on those shared expenses. That's quite a bit, and it adds up. So what I want to show you on the right-hand side is ECLC, the Early Care and Learning Council, and the New York, see if I know the acronym is NYAEYC, but it stands for Association for Jess? AEYC, Association for the Education of Young Children, I think is what it stands for.
Yes, that is it, Grace.
Yeah,
I was just trying to remember what all those acronyms
I am
are.
like, what is that? It's just NYAEYC. Anyway,
Yeah.
they jointly run this fantastic platform. And so this platform, it's on the internet, and New York Early Learning Resources is the name of it. So if you're a childcare center or if you're a childcare home, you can use this platform. It has like 2,000 resources on it. They're templates, they're policies, they're one-pagers, they're resources in almost every category there is to operate a childcare program. I call it, frankly, childcare in a box, because it has, if you're not a childcare chain, like KinderCare or something, then this is the resource for you, because you don't have to recreate the wheel. It has a lot of things in there that, whether you're a center, whether you're home, can really help. So if you're a family childcare home, there's a section of this online toolkit, online resource. It's called, it's a family childcare toolkit. It's like a clearinghouse of all resources for family childcare. So what I did was put in this box some links for you. And I think Jess or Alyssa, you could probably send out this slide deck, right? Because you can use
Grace,
these.
we'll send out the slides and the recording to all who registered. Thank you so much.
Okay, great. So you can click on these links and you can get to templates. And the beauty of a template is, wow, you don't have to recreate everything yourself. So for example, what I just went over on this time space percentage, there's a one-pager on it in the platform. It's in English and it's in Spanish, and it gives examples. There's a monthly family childcare provider time tracker. What's that? That's an Excel document, and it will have, for example, the date. And so what is it you did? I could say, I planned lessons for the week. I did a lesson planning, and it will say, okay, how much time did you spend doing that? And I might put 3 hours, maybe that's what it takes once a week to do kind of a lesson outline for the week. But it has categories for, okay, So the kids might be in my program for 8 or 9 hours a day, but there are other columns and you can fill in 1 hour here. Maybe it was doing the shopping list and thinking through the different menus for the week. 1 hour there. Maybe it was cleaning. Maybe it's 2 hours because it's before and after, before the kids come and after. But the point is, if you understand your business deduction on the shared expenses will be higher if your time is recorded and organized, and you can add it up, and you can use this monthly tracker because it's a good way to document it. Here's the thing you can't do: make it up, right? I would love like my time space percentage to be 90%. But if you put down 90%, maybe it is. Or maybe the IRS will say, really? That seems high. Show me. You never want to be in the show me situation if you don't keep the records to back it up. So the fact that you can take deductions, 100%, if it's a business use, a partial percent based on your time space percentage, if it's a shared expense, you've got to keep the records to show it. So there are these trackers. They're simple in Excel. They're already set up for you. You can edit them. You can add to them. You can delete things that maybe don't apply to you. There's a monthly expense log. I put a link to that because, you buy gas. Well, if you go and drop kids at school and you pick them up, or you go shopping for the kids, these are, business expenses. So you can log the gas. Maybe there's office expenses. Maybe you got a new computer, or you got a printer, or you got toner, or you got paper. There may be different expenses. So this monthly expense log is an Excel spreadsheet that's already set up with some of the major categories. And all you have to do is, oh yeah, I went to Costco and I purchased, maybe it's sand for a sandbox in the backyard that the kids use, when they come to your house. You put down what you purchased, you put down the price. Some people have asked me, well, is it a good enough record if I have my monthly credit card statement? And my answer is no. So the reason for that is, if you're like me, maybe you have a better bank system than me, but if you're like me and I get my credit card statement, it's going to say, oh, I spent $100 at Target. I spent $120 at Walmart. I spent $50 at Costco, whatever it is. But it's not going to tell me the items that I purchased. It's only going to tell me the vendor and the amount. And so when you keep records, it's important that you say, okay, it was Walmart and here's what I bought, supplies. And so you can either keep receipts, or you can jot it down in a spreadsheet, or you can keep both. But the point of it is, when you add up the expenses that you've made to support your business, it's not based on faith. You got to be able to have a record system in place to show that was an allowable expense. So I'm going to go over the form that you do that on so that you can see it. But I just wanted to show you in this toolkit because if family childcare providers, well, centers can use it too, but I'll be honest with you and tell you, if you're a childcare center, then I know about half from the surveys I've done across states, about half probably have some kind of automated software like ProCare or OnCare or some kind of system. And so all of these things can be automated through the software. But for the half of childcare centers that aren't using a software program, if you got a stabilization grant, I would urge you to think about investing in an automated system. There's the short-term learning curve of going through some training on it, but there's the long-term time savings in automating everything when you serve the volume of kids in a childcare center. It's not quite the same in a home, in a family childcare home. There are software products that you can use. KidCare is a great one. I'm not recommending a particular vendor, but I'm just saying there are products out there. But at a minimum, if you're a family childcare provider, record keeping is boring. I don't know anyone who says, oh, yay, I get to, do my records on Saturday morning. There is nobody in America who probably thinks that. But if you approach record keeping as, I'm doing this to support my business, and because I know if I keep my records, then at the end of the year, I'm not scurrying like crazy trying to figure out everything for my taxes. I've got everything organized. I'm not overwhelmed. I can sit down and either do my taxes, or I can work with a tax preparer to do it. Or when I get to the slide about where to get free help, you can go there. But whether someone helps you or not, what they can't help you do is manage your records. So thinking about record keeping is boring, but the reason for it is if you can do it, it's going to reduce your taxes. There's nobody I know who says, oh, I want to pay higher taxes. Nobody says that. So think about some of these tools. And I will say, on these stabilization grants, if you don't have software, maybe something that you want to think about. There are lots of options out there, but it could be an investment that has the long-term payoff of not only saving you time, but makes it more organized and helps you at the end of the year, because you can like press one button and spew out everything that you need. So let's see. So I've kind of talked about this family childcare toolkit and talked about the time space percentage. So what forms do I use? Where does that come into play? And Schedule C is the profit or loss form generally. But if you're a family childcare provider, then you need to know Form 8829, because that's the form that's used when you want to take the time space percentage. And that's the form that's used, if you have expenses that are shared, you use them for your business, but you also, use them in your home. So I'm going to go over it, but I just wanted to kind of show you big picture. Anything that's home related, that's also used in supporting your business, it's Form 8829. Otherwise, it's probably going to be in Schedule C. If it's an item that you purchase to support your program and it's used 100% for your business. So, I told you that I would try hard not to bore you. But I do think it's important to see it, like, what does the form look like? And, what goes where? So I just thought I would give you an example of just a couple of red lines that do that crosswalk, so it's easier to see. So mortgage loan interest is, deductible. Where would you put it? Property taxes, deductible. Where would you put it? Rent, deductible. Where would you put it? Utilities, all these things. And with the exception, depreciation is something like for your house. If you're partially using it for business, you might depreciate it over time, which means you don't get one lump sum deduction up front. You take that over a period of time. If you make an expense that's generally over $2,500, you generally wouldn't take that as a deduction. You would depreciate it. That would be like an asset of some type. So think of above 2,500, you're probably going to depreciate it. And where would you put that? Under the depreciation section. Otherwise, it's going to be a deduction. And the time space percentage, that's going to be applied against these expenses. So you're going to get a percentage. And that's why it's really important to think about these records as, how much time is it that I spend on my business? Because I know a lot of providers are really spending like 65 or maybe even 70 hours a week on their business, even if that isn't that they may not be caring for children for 65 hours, but they're putting that kind of time into their program. So the other thing that I wanted to point out is these things, with the exception of depreciation, all of these things are also eligible expenses under the stabilization grant. So I do have a slide coming up more about that, but thinking about, the stabilization grant is income, but if I'm using it for eligible expenses that also going to get me a tax deduction, then you don't have to worry that you got this big stabilization grant and it's going to increase your taxes. It's not. At the end of the day, you probably have more money left over. But it's the way you think about it in the crosswalk over to what are things that I could spend it on that are also business deductions. And that's just about everything that's an eligible use of that stabilization grant. So I talked about the time space percentage and how it's applied to things like your home or utilities. But Schedule C has a bunch of lines on it. And I think I have a screenshot that blows up the expense area even bigger. But these are common expenses that are deductible. So advertising, let's say you had $100, you can see on line 8, that's where you would put advertising. Contract labor, probably if you're a center, that's 100% deductible. But if you're a home-based provider, it might be partially deductible. Like you got to shovel your walk in the winter because the childcare kids have to come into your house. You may have to shovel your driveway so parents can drive in and, have a place to park when they bring in their kids. Or, raking in the upkeep of your yard. Let's face it, parents are looking for childcare. They're going to do a drive-by. They don't like the look of the outside of your place. They may select somebody else. So the upkeep, all the things I think of, oh my gosh, how much time do I spend on weekends, raking and bagging and things like that. But that's an investment in your business because that's what parents do. They drive by and they expect you to keep your property up. Office expenses. For example, in the stabilization grant, let's say your computer is 5 or 6 years old. Maybe it's slow. Maybe it crashes every now and then. The thing about technology is it's great the day you get it, and it's a little bit like a car. Every year you own it, either more things start to go wrong with it or it reaches the end of its useful life over a period of time. Technology faster than cars. But maybe you want to think about investing in your business by going to Best Buy or Costco and seeing what kind of good deal you could get on a laptop, on a printer, so that maybe there are forms and things that you can print out, on cables. Maybe you want to use your laptop with an HDMI cable and attach it to your TV and show kids videos. Or maybe you already have a DVD player and you don't need that. But there are different things that are business expenses. And so think about an opportunity you might have with that stabilization money to upgrade things that are maybe wearing down on their usefulness. Supplies that you purchase for the kids, obviously, you can see that on line 22. Other expenses. There's actually a whole backside to this, and you can write things down that might be other expenses that maybe don't fit into some of these line items. And as long as you're keeping records and as long as it's to support your business, then it's fine. Write it down. So I know it seems like I've kind of spewed a lot, but I do think it's important to understand the connection between keeping records so that at the end of the year, it's not overwhelming for you. But probably more importantly, I think we all read in the newspaper, oh, these Fortune 500 companies don't pay taxes, or these super rich people, they don't pay taxes. I think that may be true. I don't really know if it's true, but I certainly see that in the newspaper. But if they do that, it's because they're smart about their taxes. It's not like they're getting away with something. It's like they're knowledgeable about every little deduction that they're eligible to take, they're going to pay someone to make sure they take it. And the payoff for them is lower taxes, or maybe for some, none. So that's kind of the same point that I'm making to you, is make the most of it. If you keep the records and it reduces your taxes, my view it is, hey, if Saturday morning once a month may take you some time to do some, record keeping, using some templates, or, getting, some software to help you, in the long run, lower taxes are better. I don't know, maybe Jess or Alyssa, if there are any questions in the chat, I could stop for a minute and then
Yeah,
go on to
it's actually
other
just want to
slides.
stop you, Grace, and say maybe this would be a good time.
That's what I was thinking. I felt like, well, I've just talked a lot.
No, exactly. Well, you get a sip of water and pause. Let me scroll up here. Let's see. I don't want to skip anybody's questions, but I do know one's popped in before.
I know somebody wrote, if I use a stabilization grant for wages, can I deduct that? And the answer is yes. I hope, in fact, while we're talking about the deduction of wages, if you're a childcare center and you're on this webinar, I know many childcare centers, I know childcare is a business, but many childcare centers maybe have fewer than 50 employees and they don't offer health insurance because it's expensive. I hope you might think about using the stabilization grant to look at health plans and what might be affordable out of that money. That would be one thing that would really benefit the workforce. And I know many childcare programs don't offer health insurance. The other suggestion I would make, whether you're a family childcare home or a center, is if you don't offer health insurance or you're a family childcare provider and you don't have it, go to healthcare.gov and see if you might be able to get decent healthcare coverage with a low deductible, with low monthly rates, because the American Rescue Plan that was passed a year ago, March 11th, 2021, when the American Rescue Plan passed, I mean, it was a really long bill, like lots and lots of pages, but a little known piece of it actually did some great, robust expansions to healthcare. So if you go to that healthcare.gov website, and you can see, maybe there's a silver plan and maybe now it's affordable. But what they did really was really invest to make it a lot more affordable. There's, monthly premiums. And in many cases, you might be able to get a zero premium plan, or you might be able to just pay $10 a month. So I would really recommend, if you don't currently have health insurance, or if you're a childcare provider and up to now you haven't been able to afford it, look and see what's available. And maybe you can use some of the stabilization money to do it. Or alternatively, go to healthcare.gov and see what the options might be and invite your employees to do so, because having health insurance is super important.
This is going back a ways, Grace, but this is if your PPP loan, if your Paycheck Protection was forgiven, you still put it in line 6. And this was
Can you say that again?
If PPP was forgiven, do you still put it in line 6?
Okay, no. So here's the thing about PPP. So I know many providers might have gotten, the Paycheck Protection Program. It's called Forgivable Loan from the Small Business Administration, otherwise known as the SBA. So the PPP, you have to put it on your tax form, but you're not taxed on it. Congress said when they enacted this program and they extended it, it's over now, but when it was live, open for applications, they said, hey, things are bad out there and we understand that, and we want to shore up small businesses. So you can apply for this, and if you get it, we're not going to tax it. The thing I would do though, because I don't know the answer to this part of the question, is if you did get a PPP, and I do have a slide on where to go for free help, but go to a tax preparer. Number one, if you go to somebody you pay for, it's a deductible expense. Number two, if you go somewhere for free, that's fine too. And there are options to do that. But what I don't know, Jess, is on the PPP, I know it's exempt from federal tax, but there were a number of states that also passed state legislation to exempt it from state tax. And I don't know if New York did that or not.
So for everyone on the webinar, remember, we have through the Early Care and Learning Council, we have access to two CPA firms, Accounting for All and Michael Crowley have been two CPAs we've been working with. So we're happy to share that information for you, and they can definitely answer that question for you. So make sure that you get that answered.
You know what, Jess? When we get to my slide, instead of sending you a PDF, maybe you could add a box that says, you know, Accounting for All or whoever you guys have a partnership with, and put in a link. And so anybody who goes through the slide deck, when they get to that page, they'll also have that link on that page.
Absolutely. That sounds
would be
great.
great.
Yeah, we'll do
So
that.
the PPP is special because you do have to report it that you got it, but you will not be taxed on it. So it's exempt from taxes, but it may be subject to state tax. So that's why I would ask. Second, if you got an EIDL, which is another type of loan from the SBA, there's interest. The interest is deductible if you got that. So I would say if you got a PPP or you got an EIDL, either have go to Jess's options for free tax prep, go to one of the ones that I list for free tax prep, or pay and take a deduction for it. But those are questions I think you should ask about just to make sure you know, dot all the I's across all the T's.
Yeah, absolutely.
So someone has asked about meals for kids. I actually have a slide on that and I haven't gotten to it yet. So I'll hold off on that one until I get to that slide.
Yep, so we're on the same one about if they can claim groceries and food expenses.
The answer to that is yes, but I have a whole slide on it.
Okay, so let me keep scrolling. All right, I think we might be caught up on questions.
Yeah, we're all caught up now. Thanks, Jess, and Grace.
Okay.
There's some in the Q&A, but I was able to answer them to direct them to their CCR&R.
Oh, great. Okay.
Thanks,
Great.
Grace.
Okay, so the next thing I wanted to talk about is car expenses. You know, if you're a center, it's 100% business. You know, if you have, in some centers, for example, not all centers, but some centers may have a van and it goes to the elementary schools and drops off kids, you know, in the beginning of the day, and then maybe it returns at 3 and picks up kids and brings them back to the center. So, you know, centers may have a van for that. So that is likely not used for personal purposes. So that would be 100% deductible. But if you're a family childcare home and you've got a car and you're using it for, you know, business purposes, let's say, you know, you drop off and pick up childcare kids at school, or you're doing shopping for your, you know, childcare program, you can take the standard mileage deduction. You get 56 cents per mile. So that's something to keep in mind. You do need to keep receipts, but what I think is, it does add up. 56 cents per mile may not sound like a lot, but I think it's pretty generous. I would recommend that, you know, if there are tolls or parking, you know, lot fees, or, you know, if you have to park on the side of the road and, you know, feed a meter, whenever you can get a receipt, get a receipt. But all of those things add up. I would recommend that you either use the Excel template in the family childcare toolkit, or have some other systemic approach that you use so that you're recording it. The business portion of car loan interest you can deduct. The way that works is, for example, if you used your car 2,000 miles for business, you know, over the course of a year, and you actually went 10,000 miles over the course of the year, that's 20%. So you would be able to take, 20% of the interest on that car. I mean, all these little things, the thing is, each one may not seem like it's a lot, but they add up, all together. And that's why, it's important to know the concepts. I don't think, my goal isn't necessarily to make you a tax expert. My goal is to introduce some concepts so you can sit down and figure out what works best for me. What can I do to help myself? And if I'm working with someone else who will prepare my taxes, what are the questions I should ask that person? And these are some of the bigger concepts, because in the end, they will reduce your tax liability. The other method, I think this is more work. I'm not recommending one or the other. Maybe you can ask your tax preparer what might be best for you, but you can keep your actual expenses. And then if you have receipts for absolutely everything, you get your business portion of it. So actual expenses, for gas, for oil, for repairs, for car insurance, for, all of these things. To me, I look for ways to reduce my record keeping, even though I know record keeping is important. I'm going to do enough that's going to benefit me, but I'm not going to go crazy about it probably. So with the 56 cents per mile, that's probably like an average, where the government is saying, hey, we're going to allow you to take this, but maybe you might be in a situation to do better on your taxes if you actually keep every single receipt, you add them all up, and then you take the percent amount against it. I don't know. That is a very individual thing. But I put it out there that there are two ways to do it, basically. One is 56 cents a mile, which to me is less of a headache. And the other is, save every single receipt. And, again, you can't make stuff up. If you go in grocery shopping and it's for your home and it's not, for your family and it's not for your kids, you've got to make sure you're only, taking the portion of these receipts that reflects the business costs. So if you're out and about in your car, but you're not on a kind of business related journey, that's not going to be, deductible. Let's see. So next, I know someone asked about the food program, or they asked about deducting meals. Absolutely. And kind of like with vehicles, there's two ways of doing it. You can save every receipt. I think it's easier to go with what the government allows you to do than it is on the keep all food receipt business, which is called the actual food cost method. So let's go over the standard meal allowance. You don't have to save receipts, which I think is an awesome gift. At the end of the year, what you do is you add up all the meals and snacks you served, and you multiply it by what's called a standard meal rate. So in 2021, it's $1.39 for breakfast. It's $2.61 for lunch or dinner. It's 78 cents a snack. And you get one breakfast, one lunch, 3 snacks per child. Now, I put in red, I guess something I'll build to, but just so you know, like, somebody's probably thinking, oh, $1.39 for breakfast. That doesn't sound like much, or $2.61 for lunch. That doesn't sound like much. But here's the thing about it. For one child eating breakfast and lunch and 3 snacks a day, that's $6.34. That's $31.70 per week. That is $1,600 a year. That's a lot of money. And if you have 5 kids, that's $8,200. That's a lot of money for a tax deduction. And so that is without keeping any receipts, but you do have to keep records. So on that family childcare toolkit I showed you, there is a meal tracker template, and you can keep records there. Now, maybe some of you are on the food program. Technically, it's called the Child and Adult Care Food Program. It may also be known to you as CACFP. Most people I know just simply call it the food program. So with the food program, you get a certain amount of reimbursement. I think most people, not all people, but most people think the reimbursement is lower than what it really costs to serve these nutritious meals. And I think that's true. But while I fight with members of Congress to increase that reimbursement rate, which is another hat that I wear trying to get our laws better, you must claim the income you get from the food program as income because it is. But at the same time, you get these deductions, $1.39 for breakfast, $2.61 for lunch or dinner, 78 cents, per snack. So if you are in the food program, you have to keep records for it. They're not going to reimburse you because you signed up for it. You have to show how many kids you had, how many meals and snacks you served, and you have to meet the USDA, United States Department of Agriculture and Nutrition requirements in order to get that food program reimbursement. If you, let's say, get the food program and you serve breakfast, lunch, and one nutritious snack, snacks that you serve that aren't reimbursed through the food program, you get that 78 cents per snack. But if it's not reimbursed by the food program, it doesn't have to be nutritious. Not that I want to promote anything that's not nutritious. I don't. But I do know, like, it's a hot day. You want to give a popsicle. Everybody gets a popsicle. I know last time I bought a package of maybe 12 popsicles, it was maybe, I want to say $3.99, $4. But that's for a box of 12 popsicles. But if each one of those, is 78 cents, I mean, that's kind of cool. So I don't want to promote non-nutritious meals, but I do want to say it's 78 cents a snack. And if you aren't using the food program, if you aren't trying to qualify for a food program reimbursed snack, you can basically serve anything and get that 78 cents a snack. I was talking to Tom Copeland one time, who does a tremendous job at Family Childcare Business Support, who's actually retiring this spring. He's really taught me a lot. He's a fantastic guy. And he told me this story one time. There was a provider he knew, and she gave everybody two saltines or 2 Ritz crackers as they walked out to join their parents at the end of every day. 2 crackers, 78 cents for each kid. She had 6 kids. I mean, wow, for 2 crackers for each kid. So it's kind of crazy, but I just share with you that, under the tax code, this is allowed, and where it goes is on the Schedule C, and you probably flip it to the back of that form, and under other expenses, you write food, and, could be for 5 kids as much as $8,200 a year or more, depending on the situation. So don't forget, any reimbursement you receive from the food program, you have to claim as income, but you're always going to be better off for participating in the food program, because while it's income, you also get these deductions. So just pointing that out. So expenses, I wanted to do just a slide on the stabilization grant eligible uses of funds, because when I looked at this list, I went to the New York Office of Children and Families website. I just wanted to make sure, hey, some states, it's the federal law, it's the American Rescue Plan that sent this money to the states, and there are certain rules under it that outline what the money can be used for. And so I went to the New York webpage to see, did they do anything different? Maybe we're going to allow other things, but these are the things under the federal law that the stabilization grants are allowed to be spent on. And if you look at them, these are things that, if you look over to the left at the form, they cross over. And so I want to say almost all of the stabilization grant, when you get it, gives you options that, yeah, you got this money, times are tough, enrollment might be down, your income might be down, but these grants will not only help support your business so that you can stay in business, but also can be used in ways that cross over to the tax form so that you can take them as deductions, like all the PPE and cleaning supplies and sanitizer and anything that you purchase. I think I talked before about technology. You know, if you need to upgrade your computer, or get a printer, or things that are used in your business, software. If you're a center and you don't have software, it is so cheap to get. And as I said before, I've done surveys across states. About half the childcare centers use some type of automated software to support their business. If you don't have it, I seriously urge you to take a look at the different options out there because of the volume of children you serve and the finances. It makes a lot of sense to invest in some automated product. If you're a family childcare home, it also makes sense to look at what's available. Kid Care is a great one as far as accounting, and you can use it for the food program as well. And there are others out there. But the point is, all of these things that are used to support your business are also eligible uses of the stabilization grant. You know, I mentioned, somebody asked a question about wages, and wages are deductible. But take a look. What are you offering for benefits? And maybe now's the time to review your options. I think everybody I know across states is saying what a tight market it is, and it's hard to recruit staff and it's hard to retain staff. And, you know, when you think about it, benefits play into that. You know, I think I passed McDonald's the other day, and out front I saw they're starting at $15 an hour. They're often offering educational benefits to go to the community college and health insurance and retirement. And I thought, wow, McDonald's? I mean, so I think it might be time to review your options with how you invest in the workforce for stabilization grants. And, you know, if you're a family childcare provider, all of these options are yours to make. They're decisions for you. And, you know, now may be the time, you know, to think about these things. I did put a link into the FAQs for the Office of Children and Families. So there is, you know, a whole bunch of FAQs, and I went through them, and they seem to be common sense things, but they boil down to, you have a lot of discretion about how to use this money. And if you look to the left, it matches over to what can be deducted, which means that you'll be better off for taking the stabilization grant, be in a better place financially, and also be able to match some of these, most of these expenses to eligible things on your tax form. If you wanted to, maybe you do, maybe you don't, but I also put a link into the federal guidance. That's kind of the guidance to states to keep them straight about how this money can be spent. So I put a link into that. And also there's an IRS publication just on business expenses. It's really long. But if you wanted to check it out, you could go check it out. I always like to provide more information. So, you know, some people learn in different ways, some people by reading, some people by seeing, some people by clicking, whatever. You will have all of these options. And like I said before, the most important thing is to keep records. And let's say you haven't. And here it is, it's March, and taxes are due, I think it's April 18th this year. You know, what do? You're in a tough spot because it will probably take you a weekend to reconstruct everything so that you are in good shape to sit down with someone who can help you do your taxes. But it's probably a weekend that's well worth it. And maybe looking at some of these templates and clicking on some of these links will have helpful ideas for you. I will give you one suggestion. So here I am with, oh, here's this yellow box and all these eligible uses of the money, and it crosswalks over to the taxes. That is true. But here's what I see across states. So I want to share it with you because I think it's important. So we all know like that dollars are green, right? But every state is going to have some reporting back to the state on how the stabilization grant money is used. And so I don't know what that is for New York, but at a minimum, it's these bulleted categories probably that you will have to report back. And maybe it won't be that specific. Maybe we'll just say, how much did you spend on workforce? How much did you spend on materials? How much did you spend on, PPE? It varies. I've actually looked at all 50 state stabilization grants and seen what they're allowing, and on the reporting front, what they're requiring. But the best advice I think I can give you is on these stabilization grants, tag them some way in your record keeping. So even though all these business expenses might be deductible, and hopefully you can set up some records that will be able to show how you spent overall money, whether that's income that parents pay for private payments or subsidy that the state pays for low income kids or grants from the state. In general, that might show you kind of in a big picture way all of the expenses that you've made, hopefully by category. But the state funds, I would urge you to think of them as, yeah, money's green, but tag that money in yellow, because when at some point you will, I don't know when that will be, but let's say it's at the end of the year, the state says, okay, you've received all the payments and we've given you till, I'm making this up, September 2023 to spend it all. You have to report back to us, what'd you spend it on? They're not going to ask for line items. They will not care about that, but they will care about kind of categories. And so it would be good practice to say, okay, as I make my expenses, if that's an expense that I paid for out of my stabilization grant money, what category was it? And just tag it by category. So you don't have to be super neurotic about every little line item reporting back on this use of the stabilization money. But I think you ought to think about it as big picture wise, that you have some type of record that has tagged that expenditure in yellow as something that can be scooped up later and reported back by the bucket area. And maybe that's health and safety. Maybe that's personnel. Maybe that's rent, mortgage, utilities, whatever that bigger bucket area is, that you have a way to capture it. Because I think it will be asked. And on a random basis, there could be an audit. And that's the thing about a random audit. Most of the time, it's probably not going to impact you. But when it does, boy, if it's not something you've, kept a record of, then it is a lot of work to figure it out. So free tax help, there's a ton of stuff I put on here. If you look at the blue box, I looked at, okay, in New York, where can you get free tax help? I actually didn't know. Jessica mentioned the 2 partnerships they have. So we're going to add that to this slide somewhere, or just like reduce the font size and throw it in here so that there's space for it. But the volunteer income tax assistance, if you're in under 58,000 or less, they will do your taxes for free. Sometimes they'll also do your state taxes. There's a Vita locator tool. You can just put your zip code in. I also, when I was, I did Google it, but when I was looking like free tax help in New York City popped up, and there's, NYC free tax prep. So I put a link into it, and it's more generous, like federal tax help. These are people who the IRS partners with, and generally it might be, I'm kind of making this up, but it might be retired accountants, and through AARP, they've strung together some people who know what they're doing. And full disclosure, it's called volunteer income tax assistance, but these aren't some volunteers off the street. These people are trained, and they are put under a quality control system, and they partner with the IRS, and you don't get to be part of this volunteer income tax assistance program from the partner level unless you know your stuff. And there's training that they have to go through, and there's oversight of what they do. So I feel pretty confident about it. It's very well run. Anyway, that's if you have income of 58,000 or less. New York City, it's more generous. So you can have 72,000 in income or less to get that free tax help. There's also something called IRS Free File, and you can check that out. Just click on the link, and you can also ask questions, and that's if you have income of 73,000 or less. So I think the IRS knows, hey, taxes are hard, they're confusing, there's a lot, people are anxious because they don't want to make a mistake. And so they've really put some effort to figuring out how can they partner with others to offer free help. I don't know why, well, it's probably in the law, the 73,000 or less. And maybe the thinking is if you make more, you can pay for it. But I just point out these free resources, they're with trained people and they're really good. And I'm sure that partners that, you know, the Early Care and Learning Council have partnered with are really good too. And so if you can get free, I would say, you know, look at that first. But also know if you don't get free and you pay, it's a deductible expense. In the yellow box, I just put a bunch of resources if you want to read more, because I know sometimes I hear something and then I want to read something about it and digest it. So I put a bunch of resources that I thought might be helpful to you. Some of them are IRS forms. Some of them are instructions for the form. Some of them, like where it says IRS Schedule C form and related information, or IRS Form 8829 and related information. It's not just related information. It's like a 50-page booklet. So know that. But, you know, on the other hand, if you invested in a printer for your business and you could print it out and it's a cost of doing business. So that's a business expense. Anyway, these are publications and forums. The IRS Taxpayer Advocate Service, I put a link on there because I like to be honest. And if you've got a problem with the IRS, these are the people to contact. You know, like if somebody didn't answer the phone, didn't call you back, or there's an email, they didn't email you back, or, you know, they weren't helpful, or they were nasty, you know, whatever your beef might be, because I'd love to be perfect, but I know I'm not. And so nobody's perfect out there. But if you have a bad experience or you're dissatisfied, then you can call the IRS Taxpayer Advocate Service. It's like a watchdog, and they try to keep their own in line. Or maybe there's a problem and they need to reach out and find out what that is and straighten it out. So I put that on there. The other thing that I think is helpful, I know it's helpful to me, like super helpful to me, are videos. So I knew the IRS had business tax videos. I've actually over the years, you know, seen some of them. But what I didn't know is the IRS is on YouTube. And so they've got all these videos now on YouTube. And I thought that was really cool. And so I put a couple of links on there, and they're also in multiple languages. And one of them, at least one anyway, is in sign language. So check these out, because as I said, people learn and gather information in different ways. I love the videos. I will say I do a lot of home projects, and there's almost nothing I undertake that I haven't looked for a YouTube video first to see, you know, oh, reupholstering my dining room chairs. How do I do that? Or replacing the light bulb in my freezer. How do I do that? I mean, think about this, like, hey, how do I fill out this tax form? I mean, having the video where somebody goes through it is super cool. So I put the IRS videos and also the YouTube IRS video channel in here in case you want to follow up. The small business development centers, they're in every state. They're located in many different communities. They're often within a university. You can also reach out to one of those. I put a link, so find one near you. You can put your zip code in and put in 5 miles near me, or 10 miles near me if you're in a rural area, or 20 maybe, but you can put in your zip code and it will tell you where's the nearest one to me. You can set up an appointment. They'll sit down with you. they give free counseling, free advice, free suggestions. And so I think knowing that they're there can also be helpful. And then my favorite, because I'm a fan, is Tom Copeland. And so I went through his website and just put a couple of key things in here that I thought might be helpful to you. Like, if you did want to find and choose and work with a tax professional, what are some of the questions you should ask? What should you look for? What should you steer away from? And so Tom had a really good article about that. So I put a link to it. Questions your tax preparer must answer correctly. I don't think he necessarily wrote that to be funny, but when I was reading it, I actually laughed out loud. So I put that one in there too. Tom is he's great. And he's anticipated a lot of your questions. And so there were a handful of these that I gave you links to. And I really encourage you, if you want to check these out, they're helpful. So let's see.
Grace, I
So
just want to
takeaways.
clarify one thing
Yep.
first. On
Yep.
our tax preparation services, so the CPAs that we contracted with, it's just they're to answer questions and to answer some minor things. They're not actually going to prepare your taxes for you. So we're paying them to just answer some minor things. They will meet with you to basically to get your ducks in a row to then prepare your taxes with somebody else. You could probably enter into a contract with them for them to actually prepare your taxes, but you would have to pay them for that separately. So they're not actually going to do your taxes. But like if you had a question about your 1099 or like, some specific thing that you weren't sure about, they're happy to answer that type of thing. Kind of like the questions you're fielding now, but something that might pop up later.
Which is great, because I know for me, sometimes I hear something and then later I think, well, wait, what? And so being able to reach out to somebody, I think, Jess, it's a great service that you guys have partnered with them. I think that can be really helpful. And as Jess said, if you're looking for someone who will actually do your taxes, just remember, all of the information here, maybe it helps you get your stuff organized so that if you do sit down with somebody, you're ready, right? And you know what questions to ask. If I were looking for someone to help prepare my taxes and I were a family childcare provider and I said to someone, I guess it's like, interviewing, have you ever done family childcare provider tax returns before? And they said no, unless they're a relative. Well, maybe even if they're relative, I would probably not want to be the person that professional learned from. I would probably be looking for someone who's done it for others, right? Like we all get better at our job every single year. And so I'm not saying look for some old person like me, but I'm just saying like, it's not about the age, but it is about the experience. So if you're looking for somebody, how long have they been doing it? And ask them, great, you've been in this job for 5 years. Have you ever done taxes for somebody in the business of family childcare? If they say no, keep looking. If they say yes, great. Ask some no-brainers and see how they answer. So on the time space calculation, can you help me on that? What form does that go on? If they can't off the top of their head say form 8829, keep looking. I mean, like you want to just understand conceptually, you don't have to be the expert, but you want to hire and work with someone who knows more than you. That is the way I look at it. And for that, you get a business deduction. Anyway,
Great.
so
Do you
big
want to
take.
take a couple questions right now, or do you want to go through your next slide and take them at the end?
I think this is my last slide.
Oh, awesome. Okay, perfect. Thank you.
This one just says questions.
Awesome. Thanks, Grace.
So big takeaways. What's deductible? These are the IRS words: ordinary and necessary. An ordinary expense is one that is common and accepted in your industry. I actually cut and pasted that from the IRS publication. So understand that. A necessary expense is one that is helpful and appropriate for your trade or business. I also cut and pasted that from the IRS publication. And the reason for it is You know, if you use it in your business, then it supports your business. So I think that's important, to keep in mind. If you do want to know more, here are the two go-to publications. One is on business expenses, IRS publication 535. The other is the business use of your home, which is IRS publication 587. As I said, both of those things are like 50 or so pages each. But I put the links in here because they could be helpful, and they do explain things, but they are long. I also put a reminder about the Family Childcare Toolkit. You can go to this link if you don't have access. For more information, you can see at the bottom, you can go to this webpage and you can contact them and find out how to join. But I think whether you're center or whether you're home, there's a tremendous amount of resources in this online platform. And because it's online, it's 24/7. And, just access to the templates means you don't have to start from scratch. That can so save you time. And if they're in Excel, if a document is in Excel, you can edit it. You can add what you need. Maybe the way it's set up, you don't use all the columns, but there are columns you would create. And so add those and save it. If you don't know how to use Excel, there's even a section in this toolkit that has a link to like a 10-minute video. Here's Excel. You don't have to be an Excel expert. You have to know how to add. The video shows you how to enter information, how to delete information, how to add and subtract. I mean, those are the basics of what you need for a record-keeping spreadsheet. So anyway, I put these here so that you understand that these things are here. They can save you time. They can save you money. They can help support you rather than everybody who's in the business of childcare having to create these things for themselves. There's so many explainers in here, and many of them in English and in Spanish. So I think that's a good thing. That time tracker, probably the biggest thing I hope you get today out of this conversation is that when you track your time, count it all, not just the hours of the day that the kids are in your home, but, if you stay and talk to a parent, if the parent stays for half an hour after the kids are picked up to talk to you about whatever it is, that half hour, that should be counted. If you're watching this video tonight, that should be counted. If you're preparing meals for the week, some kind of menu thing, that should be counted. If you're planning activities for what's going to be offered for the week, that time should be counted. If you go to CPR training, that time should be counted. All of these things, if they're time that you are taking, like cleaning, to invest in the operation of your business, that goes on your timesheet. And in the end, you add up all the time that you're spending and you'll be surprised. I'm sure that nobody's working a 40-hour week. You're putting in a lot more time. And that helps you as far as those shared expenses, because you have that time, space, calculation. So the higher number of hours that you have in that calculation, the bigger your tax deduction is going to be. So just think about it like that. Anyway, if you want to maximize your income, you start by reducing your tax liability. You reduce your tax liability by deductible expenses. And how you make that happen is by keeping records. So if you do have any questions, glad to answer.
Grace, thank you so much. There's a couple in the Q&A. I can read them out to you if that's okay.
Sure.
Okay. So the first one is going back on the Schedule C. Someone is changing their back porch into a changing area and their and a half bath.
Yeah.
Do they claim this on the Schedule C repairs and maintenance line?
So say that again. I heard half bath and what else?
Yep. So I'm changing my back porch
Changing
into a
table.
changing area and half bath.
Yep. Okay. Is it used 100% for a business, or is it a shared expense? Does anybody in the family also use that bathroom?
Carol, would you mind typing that answer in the chat for us?
Can people come off mute, Alyssa?
Possibly. Let me.
Yeah, unfortunately they can't, Grace, because it's set up as a webinar.
Oh, okay. All right. So let me answer it both ways. If you are, changing that area, and it's 100% used for business, then you would
Oh, yep,
deduct it
that's what she
repairs,
said, 100% of
repairs
for
and
business.
maintenance on Schedule C. If it's also an area that your family uses, like they might not use the changing table, but maybe they use the bathroom, then it's going to be that, on the form 8829, it's going to be that you list it there, and then your time space percentage is going to be applied against it. So you get a deduction, but it's kind of a partial deduction, a shared deduction, because it's shared space. So it all depends on the shared space.
All right, thanks, Grace. I'm just popping in a note. I can say it right now. Please, if you have any questions, please put them in the chat or the Q&A box, and we'll go through. Question.
They're kind of glancing through too.
This one's clarification. That they need to report the income.
We can't really hear you, Liz.
Can't hear me good?
Barely.
What about now?
Yeah,
I'll
now
get really
we can.
close to the screen. I'm so sorry. You get to see my face straight up. So just so I understand, I need to report the income I receive from the food program.
Yes.
I can use the standard meal allowance that Grace is going over now.
Yes.
Can I also deduct the food that I purchase for the children?
That's complicated only because you need to choose. So I think I had a slide. Maybe I can go back to it. Hang on. Okay. So if you want to deduct the actual food costs by keeping the receipts, that's called the actual food cost method. And yes, you can do it. I just think it's a lot. I mean, I guess I'm not advising anybody either way, but I will say keeping all those receipts and then proving that it's all for the childcare kids versus in your family, it's hard. You might end up having to explain it. You might end up, yeah, I mean, you might not, you might never get audited, right? But let me give you an example. You buy a dozen eggs and you only serve those eggs to the childcare kids. You don't let your own kids have any eggs. Maybe that's how it goes, and that's fine. And so the receipts in that case, it's all food only eaten by the childcare kids. You've got to keep all of the receipts, and you may be in a position of having to show that this was only used for the childcare kids versus kind of shared. Personally, I think, yes, you can do that. And maybe in the end it works out, but I think it's just easier that if you don't have to keep the receipts and you, can add up all these meals and snacks and take it that way, you don't have the headache of knowing down the road you have to prove it. On the blue box, what you would have to prove is for record keeping, and this is only in the case of an audit, but for record keeping purposes, you would have to show, yes, I had 5 kids this week every day, and they all had, lunch and dinner and 3 snacks. And typically, people usually keep either weekly or monthly records of how many meals per day, how many snacks per day, and then add them up weekly and then have them monthly. And typically that's what I see. And then you just apply the kind of standard meal allowance to it. If you want to go with the actual, that's fine, but know that you have to keep all the receipts, and you also may be in the position someday, if there is an audit, of proving, showing, no, I only purchased this for, my childcare kids. Maybe that's easier with, I'm thinking what's in my pantry. I have Pop-Tarts, okay? So maybe that's easier with the Pop-Tarts, because maybe grown-ups don't eat Pop-Tarts, but I just broke that rule because I do eat Pop-Tarts. But, here's the thing.
Pop-Tarts are amazing, Grace. Everyone just needs to eat a Pop-Tart and you'll feel better.
I love Pop-Tarts, but just understand, if you go with actual receipts, you have to keep them all, and you may be in a position of having to show that this was stuff you purchased and was only eaten by the childcare kids, versus this was stuff you purchased and the childcare kids and members of your family ate it. So to me, it's a bigger headache, but maybe there's a payoff to it. Only you can make that, decision. But do know, in every case, reimbursement from the food program is income. You have to claim it. But I will say, I don't know if I've ever seen anybody who, I have seen many people who tell me that the reimbursement is less than the cost of food, probably particularly now with the way that grocery costs are going up. But the deduction is pretty good. Like, you can get a box of cereal, for example. Don't laugh too hard, but I have Fruit Loops, and I also have multi-grain, cereal. And my kids like the Fruit Loops, and I want to say it maybe is $4.99 a box for Fruit Loops. Well, gee, $4.99 a box for Fruit Loops, and I have 5 childcare kids, and they all have, a bowl of cereal. Of course, that assumes that you're not on the food program, because I don't think Fruit Loops would meet that standard. But if you did give them, Fruit Loops, you get $1.39 for each of the 5 kids. And that box of cereal might last the whole week. So, I mean, you do the math, but it's a pretty good deal on the standard deduction.
Thanks, Grace. Got a couple other questions. This might just be a quick one.
I don't want to be against the food program and preach non-nutritious meals, because that's not me. I totally want to support nutritious meals and snacks for all kids.
But Pop-Tarts. So another question we have, do these same Schedule C reporting procedures apply to 501c3 religious preschools?
No, I would go to a tax preparer, because 501c3 nonprofits, you're probably going to file a 990, and I would seek professional advice. You're going to have similar concepts though, but you will have different forms.
Thanks, Grace. Another question, New York State is asking for proof for unemployment if we took the PUI. Any advice on that process?
Proof for unemployment. I think, but I'd have to look it up. At least for federal taxes, your first maybe 10,000 and unemployment is not taxed, and only the excess is taxed. I think that changed, like it was a COVID change when they invented PUA. I'm not sure on that, but I think if you got pandemic unemployment insurance, here's what I am sure of. The agency that issued you the pandemic unemployment insurance should have sent you a letter, and that letter should say, this year the agency issued, I'm kind of making it up, but let's say $2,500 in PUA payments. And then that amount would probably be transferred over to the tax form. But I would ask one of the partners that Jess recommended. But you should get a letter. There is, and states are all over the map with what they did. I know the federal government raised the threshold on unemployment because COVID, obviously, it was a tough situation, and they increased unemployment and they extended it. I think the supplemental unemployment expired in maybe September. So it's been a while. Nobody would have gotten a full year of unemployment in 2021. But if you did get unemployment, the paying agency should have sent you a form. And that form should say the total for the year. And it wouldn't be a year because there wasn't a year's worth of unemployment, PUA unemployment, in 2021. And some states may have exempted a different threshold for taxes. Like the federal government, it's either 7,000 or 10,000 you could get free before taxes apply. And states may have piggybacked on that. You know, hey, the feds decide we're not going to tax you, so we're not going to tax you either. So I don't know the answer to that, but I think it's a fair question. Look and see if you got that form, if you received unemployment. In general, unemployment's not free. It's counted as income. But when COVID hit, some special rules applied.
Oh, she's popping in the chat. Michelle is saying they asked for proof, not sure what proof to send them since the grants had me inflated, although my business was closed. It's not the income. They're asking for proof that I qualified. When I qualified, I made sure that the grants weren't covering the same time period, but the quarters don't read the same way.
Oh. So, okay. So I want to make sure, let me see if I can find the question.
Yeah, if you click the Q&A box,
Oh, it's in Q&A. I was in the wrong box. Okay.
oh,
Q&A.
good.
Oh,
So the initial question, New York State is asking for proof for unemployment if we took the PUI, and then if you go to the open section, it's from Michelle Kessler.
yeah. Okay. So I do understand what you're asking. This is a tough one because there were requirements. So for context, it used to be pre-COVID that states had certain rules to qualify for unemployment. And COVID hit and millions of people were unemployed and many of them were self-employed. And in general, the way states set up their unemployment programs was if you're self-employed, you don't get unemployment. You only get unemployment if you work for an employer and the employer is paying basically unemployment taxes, and that's what funds the unemployment trust fund. Then COVID hit and the CARES Act passed and a new unemployment program was created, the pandemic unemployment program. And basically that program said, hey, for the self-employed, we're going to let you qualify. So that's what the Fed said. Then the states were in charge of implementing the program. So the states came in and different states had different rules about who qualified. And some of them said for the self-employed, you had to earn X amount over a certain number of quarters. And if you didn't, you couldn't qualify. And another thing I saw that really affected family childcare, and I just don't know if this is a situation in New York or not, was you had to know, first of all, what did I, earn last year? But if you're closed, what you earned last year doesn't have anything to do with, where you are now. Some of the programs were set up, if you're self-employed, you had to work a certain number of hours. Family childcare may or may not have qualified. I don't know specifically what they're asking for proof.
Grace, we have someone popping in the chat. Thank you, Carol, to send in your daycare license, and it tells you on the site what to send for proof.
Oh, hang on, I'm looking. Is that in the Q&A?
That is in the chat box.
Okay, let me look in the chat. Oh, okay. All right. So that's a New York thing.
Carol was saying she just had to do that. Thank you, Carol. And then Michelle was saying I returned staff before I returned myself, so the business was earning while I was collecting but not profiting. It's complicated for sure. She says thank you.
Okay. I think it was really hard across states for family childcare providers to qualify for PUA. So if you got it, New York might be more generous than the other states, but it was complicated about how to access it. And if you work too many hours, but your income declined, you didn't get it. I mean, here was the biggest thing that I saw with family childcare was if you, that some states said, hey, you're either unemployed or you're not. But if you're working part-time and you work more than 30 hours a week, then you shouldn't get unemployment. But the issue is, if you're a family childcare provider and you go from caring for 5 kids down to 2, you've had a tremendous reduction in income, right? But your hours might not be reduced, because if you're still caring for 2 kids, you're still working 60 hours a week. So the point of PUA was to try to make people whole. So I saw a lot of family childcare providers have a problem explaining how they're working 50 hours a week, but they've had a significant reduction in income and they still don't qualify for PUA, or they get a reduced PUA when they shouldn't. But anyway, glad you have the site. If you provide that link to Jess or Alyssa, I'd like to take a look at it too, in case this issue comes up again.
Hey, Carol, if you happen to have that link, if you wouldn't mind sending it to me or popping it in the chat. A lot of people are saying, can I have that? Can I have that? So if you have that on hand, thank you so much. Grace, I know it's 7:43. Can we do one more question?
Sure. I'm just looking through to see if there's any that I missed.
We just have a couple more in the Q&A. These might be quick answers for you. I'm a family daycare provider. I do not have any employees or outside contractors. I have been writing myself, quote, payroll checks. Am I correct that this is a deductible expense?
Well, that's an interesting question. So it is an allowable expense if you're using your stabilization grant. But I would check with a tax preparer about whether you can deduct it, because I don't think so. But what you can do is take deductions against it. I mean, it's income. The money that you earn from the parents, that's income. The thing about family childcare that makes it a little different is you're not an employee. So typically wages that you pay are a deductible expense, but there are special rules if it's for you, like yourself. So I would ask a tax preparer on that one, but I would say no. But I would say claim it as income and then look at your eligible expenses. But if the question really is it an allowable expense on a stabilization grant? It absolutely is. You can take the whole thing as income if you want.
Thank you, Grace. See, can we deduct personnel car going to the center and running business related errands, not just picking up kids and dropping them off?
Yes.
Awesome. And if I received the OCFS Child Care Stabilization Grant, I'm wondering how much tax will I need to pay on that income?
Here's the thing. I can't really answer that because it depends on a lot of other things. So number one, it depends on your tax bracket. What I can tell you is this is something, you can talk to a tax preparer about, but generally the tax is probably going to be between maybe 25 and 35%. I mean, you have to claim it as income. So you're going to have to pay self-employment tax on it, 15.3%. You have to pay Medicare on it. You're going to have to, depending on your income bracket, pay taxes on it. But your taxes, they're not like a flat amount. It's like a graduated stream. So between 10 and 20,000, your tax might be this. Between 21 and 24, it might be on that incremental amount a bit more, and it goes up as your income goes up. What I would say is, if you're concerned about the taxes, set aside 30% and just know not to spend that. And then you've got like a little fund for yourself that's kind of a reserve for taxes. But I would also be thinking of ways to invest in my program so that I can use that money. Yeah, it's income to me, but how can I use it in a way that's going to benefit my program? You know, you can pay yourself, but do you have retirement? You know, you can get a deduction for SEP. That's a self-employment pension plan. And maybe you could use some of that money, not directly. I don't know if that would be considered an allowable expense, but paying yourself would be an allowable expense. And out of the money you pay yourself, if you use that for an IRA, or you use that for, you know, a SEP, a self-employment pension plan, that's a deduction. So you can invest in your own retirement down the road.
Okay, we have another one, Grace. Since corporate taxes are due 3/30, my taxes were done already without me giving my accountant all of this info. And I certainly don't fill out the forms and schedules that were previously mentioned to do. So to take full advantage of this, do I need to amend them now? What would you suggest?
I would say yes, but where's that question? I just wanted to look at it.
That was, I think you would get it. It was for the hosts and panelists at 6:50. If you scroll up in the chat.
Somebody wants to know if they can get a new door if the parents slam it every day and it's off the hook. Absolutely, that's a business expense. Okay, so is that in the Q&A?
It was in the chat at 6:50. So hosts and panelists. I think you're panelists, so you should be able to see it.
Okay, hang on.
So just scroll up 6:50.
Okay. There's a lot of stuff in this chat.
Yeah.
6:45. Okay. Oh, I see. You know what? I would go to whoever prepared your taxes. Is this Christine? And if your taxes were filed March 30th, then you probably have a copy and you can look through and see what is it that they did. And maybe from some of this webinar, it might be more clear to you now. I know sometimes people can get the tax forms and glaze right over because there's so much, right? But if you go over it, maybe things will be more clear now. If there are things that they didn't include, then you can go back to whoever prepared the taxes and you can file an amended return. In fact, you can go back like 3 years. So, you know, there's a cost to doing it because in general, someone has to help you do that. But you can go back like in time and not think of it as etched in stone for sure. People file amended returns all the time. And in COVID, I'm sure people are doing it because these tax laws have changed and things have been made more generous and other things have been invented. And so I wouldn't be surprised at all. And if you're a center, you could be filing, you know, quarterly. You know, I don't know if you used any tax credits last year for the employment tax credit or if any of the sick leave came into play, but there were special things you might have taken. And if you haven't, you can go back and take a look at it. Ask your tax preparer about it. I hate to say this because it sounds awful, but maybe a question for a tax preparer is, hey, was there anything in the 2 years that where Congress was making all these changes in the tax laws that I should be aware about that I didn't use in my tax form that I didn't ask you about? And see how they answer it. I mean, you know, there were tax credits for sick leave. There were tax credits for, you know, paid leave for somebody, if a business let somebody go get a vaccine, for example. There were tax credits for the retention credit. There were lots of different options that were newly invented that are now over. So it was for a temporary period of time, but they did exist in 2021 and they did exist in 2020. They were made more generous in 2021, and now they're over.
Thank you, Grace. I think we're all caught up on questions. Jess, I don't think we got any more, and I'm not sure if you were. I think we're all set. And
Wait, somebody asked a question, which
I think we have
Yes.
literally just dropped in.
Yeah.
oh, okay. So somebody said, I took a workshop that stated the stabilization would not send our income into a higher tax bracket. Our earned income would be taxed as qualified. If the total goes into a higher bracket, only the stabilization grant can be taxed at the higher rate. Any input? That's kind of true, but it goes to what I was saying. Like the money you receive from the stabilization is on top of the money you already have. And the way taxes work is they gradually increase. It's not like you're going to have this big high tax for this one grant. It's like, where are you on that slide and what applies to that increment of tax? So I think that sounds like what someone was trying to explain, but I would still say better to get the money than not. It is almost always, it is always going to increase the amount of income you have, even if you pay taxes on it. It's kind of like, you know, if you win the lottery, would you not enter the lottery because when you win it, you might have to pay taxes on the earnings? You're always going to have more money afterwards, right? Even if it's taxed at, you know, 35 or 40%, which it would not be. But that means you have, you know, 55, 60, 65% for you that you wouldn't have before, that you can spend in any way that you want. So you know, if someone explained that the stabilization is on top of everything else, that's true. If someone explained that it may not be taxed, that's likely not true. The question is, what's the percent rate that will be applied to it? And that will depend on the expenses and how you're able to reduce your tax liability as to what that rate's going to be. Did we get this
Grace,
person,
thank you.
Christine?
First, Christine's question was the one that was the 650. I scrolled back to find it.
Oh, okay. Okay. Okay.
All
So
right.
we recently spoke with somebody who was talking to us about the employee retention credit. So we have some information about that if anyone has any specific questions on that.
The employee retention credit expired, but watch Congress. Jess does a lot of federal and state policy. So if the employee retention credit gets restored, Jess, I will shoot you an email and you can let anybody know. But I think the employee credit was a really good deal for childcare centers. It wasn't for homes, but it wasn't available for homes, but it was for centers. But if you're a center on the employee retention credit, it expired, I think, September. But there's talk now that it could be revived because small business is still hurting. And so watch this spring to see if Congress does anything. And if they do, I'll let you know, but it's being talked about. So we'll see.
And to your point, they're talking to us about going back if you want to go back and manage your taxes if you didn't take advantage of it.
Yep. Anything else?
Grace, thank you so much for dedicating your time to be with us here today. And to all the folks on the call, you will be receiving a recording of this as well as Grace's materials, and we'll get that out to you tomorrow. Thank you so much again, Grace, for joining us tonight. We really appreciate you.
Sounds good. And if there are any questions and you didn't ask them, my email's here. You can always shoot me an email. And Jess is going to add to the slide on the free partnerships that ECLC's entered into. And good luck. Don't let this get you down. This is an opportunity. Think of it that way.
Absolutely. Thank you, everyone. And thank you so much, Grace.
Bye.
Have a great night, everyone.
Bye, everyone.